All right, sorry about the delay there, guys. I apologize. How are you?
Hey, Michael, doing well. Thanks for coming up, man. It's great to speak with you
It's
today.
been fun. As I heard you say it, I don't necessarily disagree. What's funny is that people don't seem to realize that it's been a pretty good week also for my funds because they were positioned properly. And it's also been kind of fun, honestly, to engage with all the insanity. My account is arguably pretty loud. I've been having a lot of fun with the Nvidia stuff, even though I have no position. I just think it's intriguing from a sentiment perspective to see the engagement go the way it's been going. But anyway, I'm sure we'll talk about that. So I appreciate the invite, guys.
Yeah, no
Michael,
problem.
do you mean to say that you don't see the value in Nvidia at a 200 PE?
I mean, it's it's like so there's people that would pointed out that tweet. They said Nvidia is fucked, right? Breaking, Nvidia is fucked, which I do because to me it's like it's me venting and I'm kind of trying to be funny with it, but I do believe it's fucked, right? And it's not because of the company. This is something, by the way, which is wild to me about the way that people think. There is a difference between a company and a stock. Nvidia is not up because of AI; it's up because of people, right? AI is just the narrative of the moment. Now, valuation can get more extreme. Fuck it, maybe it goes to 1,000. Okay, cool. I mean, you never short a mania, you never short a dull market, which means you never short period, which is why I'm very anti-shorting in general, right? But the broader point is like if people don't think it is a mania, I think they're fooling themselves. I mean, I put that tweet a little bit earlier. It's like I wish FinTwit were around from 2000 2002. It would be, I'm sure, almost exactly like right now in the way that people are thinking and saying things.
Awesome, man. So I guess I'll go ahead and give us the introduction. So, guys, welcome to another edition of our afternoon spaces. Today we have Market Side Fireside Chat with Michael Gayed. Sorry if I mispronounced your last name, brother.
Dude, that was actually pretty good. I used to do the media rounds all the time, and it was always 50-50. That was pretty good.
Appreciate you, man. Yeah, and so today, guys, we're going to try to run this space for about 30 or 45 minutes, and it's going to be exclusively on Michael's background, how he got into investing, the resources he's used to navigate these markets, as well as his current outlook. We're going to talk all things macro stocks and also some other risk on stuff, potentially crypto. Would love to know his thoughts on that. And yeah, we'll get started. So, this is King Wabi, by the way, guys, speaking through the Because Bitcoin account. And yeah, let's get it started. So, Michael, why don't you introduce yourself, what you do for a living, and more or less how you got into the world of finances? Like, what led you to the world of markets as a whole?
Yeah, and I appreciate that. And some of you may have heard the background, but kind of real quick. So, as I keep emphasizing, I have skin in the game, and this has been my life. It's not some game to me the way that I think it is for a lot of people on FinFit, which is fine. But I grew up in the business. My father was an immigrant, came from Egypt to the U.S., had no money in his pocket, fell in love with markets, found his way to Merrill Lynch, fell in love with technical analysis, ended up working with Bob Farrell, kind of this legendary technician in the late '80s. Wrote 2 books on markets. I grew up seeing his ambition, seeing his passion, his love for markets, seeing his boisterousness, if that's a word, which I think I bring to Twitter as well. He started up an RIA in 1991. I grew up seeing that investment advisory firm. He is part of Split in the late '90s. He started a hedge fund. He had guys like Stanley Druckenmiller as clients in his hedge fund. I joined the family business. He passed in '08. Family business closed. I was not of age to take the business over back then. Had to kind of reinvent myself and my career post GFC. Started doing a lot of writing, getting a lot of market analysis largely correct, prior to QE3. And Launched 3 funds: a mutual fund in 2012, the day before QE3, not exactly the best of timing, for a risk on, risk off strategy, and then Roro and Jojo, 2 ETFs in 2020 and 2021, respectively. The only reason I mention the funds is they're rules based, and I think one of the challenges in people trying to understand my background and how I look at things is they can't differentiate between me as a thinker, as somebody who's trying to put out research, and me as a portfolio manager of funds that would run the exact same way whether I were dead or alive, right? Rules based means it's mechanical. Now, for me, markets are one of the most interesting and challenging domains to focus a career on. And this goes for stocks, bonds, Bitcoin, anything, in the sense that no matter what anybody on FinTwit says, the reality is there's no clear link between effort and result when it comes to investing. It's not like if you spend an extra hour after having spent already thousands of hours that you're going to necessarily get better investment returns because there's always a degree of randomness in markets. There's always a degree of luck. And oftentimes people confuse their own portfolio returns for skill when it may just be luck in the small sample. Now, I say that as somebody who believes in cycles, who believes that there's a lot more to luck in this game, both good and bad, right? And who has put up real capital to try to make it in an industry which, believe me, folks, it's not easy to be a fund manager when you're competing against Vanguard at 5 or 10 basis points, when you've got a bunch of strategies that are Me Too's that are just hugging the S&P. If you want to get assets, you got to perform. If you got to perform, you have to do something different. But doing something different means you're vulnerable to years like last year, right, where your strategies just don't work in that cycle. So long-winded answer, but grew up in the business. I try to keep my Twitter feed entertaining, interesting, but there's a lot of real, serious academic literature that goes behind everything that I say, believe it or not. And I will tell you unequivocally that it's not a slight on individuals, but it's a slight on the crowd. FinTwit and what you see on social media is oftentimes a contrarian sentiment indicator. And we'll get into it, but I think we're at a point now where the sentiment is so beyond absurd on the bullish side that it might be worth considering things turning around. And by the way, that's coming from the standpoint of somebody who was risk on this week.
Michael, lovely introduction, brother. I did want to throw this to your direction. Do you think, with the inventions of Bitcoin and Ethereum and digital assets as a whole, do you think that's changed the way people invest? Right, we have all these financial apps, right? These fintech apps like Robinhood, Webull, with a click of a button, you're in the options market. You buy and sell at your own leisure, and both panic and euphoria tend to be priced in a lot quicker, as we saw from last year, right? I think if someone said in January of 2022 all the things that would ensue over the next 15 months, I mean, golly, you'd be stupid to say that the SPX would be at 4,300, BTC would be trying to crack 30K, ETH would almost be at 2K. So, do you think things like Bitcoin and also some of these fintech apps have changed the game relative to how the financial markets were, say, dot-com bubble, or perhaps the late 80s, where you'd have to call your broker to put it in order, and most people didn't even know the prices of their stock until they were either up 300% or down 80%. Would love to know your thoughts on that, brother. And full disclosure, I am I am Gen Z, so I've really only been in markets since December of 2017, and my introduction to investing as a whole came from the cryptocurrency market. Thank you, brother.
Yeah, no, so this is actually a really good discussion to go into. So first of all, by the way, just to be clear, I don't know where Matt Damon is. But if anybody in the audience does know where Matt Damon is, please let me know, because I've been trying to find him. Okay, so first of all, let me preface this by saying I'm not anti-crypto. I'm not anti-Bitcoin. Notice I differentiate the two. And what I am anti is anti-overconfident narratives. Okay, what I am anti is overconfidence, which leads to leverage, which leads to crashes. What I am anti is investing based on faith or emotion, as opposed to real data. Okay, so to your question, I present all over the U.S. at CFA chapters on these different research papers I put out, and I always make it a point to say that the best thing anybody can do, most people, is actually to go for the broker that has the highest commission per trade. Now that sounds really, really weird, right? It's like, why would you want zero commission trading? Why wouldn't you want access? Okay, there are studies that show that investors that put their money to work into an S&P 500 mutual fund, which prices once a day, tend to have better returns than investors that invest in S&P 500 ETFs, which price second by second. They're both the S&P, but investor returns tend to be higher in a mutual fund structure than an ETF. Now, why is that? Because the ETF is priced second by second. So there's temptation to overtrade based on gut feeling, right? And history has shown time and time again the number one reason people tend to not do well when it comes to investing is they overtrade. They churn their account based on the ease with which they can get in and out. They think stocks can go down. Oh, okay, I can always get back in later. Oh, or the stocks are going to go up. Okay, I gotta chase that, and let me keep rotating around different individual stocks and miss the momentum in whatever's working in the here and now. So I do believe there's a big positive to the democratization of finance, that the ability with which more and more people have been turned on to investing and trading. I think though it's a detriment to themselves if you don't have barriers, right? Because the barriers are what keep people in the game to not overtrade. Now, the final thing I'll say is I want to see the blockchain, crypto space, Bitcoin space. I want to see all that do well, and for reasons that people may not be aware, at Tidal Financial Group, which is the advisor that I'm under, we're the ones behind the biggest blockchain ETF out there, BLOK, the blockchain ETF. That's us. Like that's a contributor to our firm's revenue and earnings. I want to see the space do well. I don't want to see the space do well because of uneducated speculation. Right? It's okay to speculate. It's okay to be bullish. It's okay to be bearish. At least have something that you can test. At least have some basic foundation that's not based on, I'm sorry, with due respect, memes, right? And jokes, and in some cases, outright pure pump and dump. Like that's not okay, right? That sucks in a lot of people into this business of investing, thinking that it's a game when it's a very, very serious endeavor.
Michael, I also wanted to know your thoughts on decentralized finance or DeFi, right? Now, some people might call it a fluff, a fluke, but the fact of the matter is, right, last year, the cryptocurrency space got absolutely pillaged. It got ransacked, right? You had, all the quote unquote golden boys get knocked out of the park, right? Sam Bankman Fried, Su Zhu, Do Kwon, and what have you, but yet, these DeFi platforms that started their development in 2016, 2017, right? Don't really want to be shilling up here, but things like Aave and Maker, they were still solvent. You can see their PEs, you can see their revenue, you can see that they've been profitable, even though like the yields on DeFi are down, they're still profitable. So I wanted to know your thoughts on DeFi, and do you believe for the younger generation like myself, or perhaps the individual that's perhaps like 8, 9 years old and wants to learn about banking and have some experience on rates, borrowing, and lending, perhaps DeFi could serve as an educational tool, right? On these platforms, right, you're given instructions on your loan to value ratio. You learn how liquidations work. There are some nice tutorials out there. And when you compare it to traditional financing, we have a good friend of the brand, Noah Seidman, who's had his money locked up on one of these regional banks for almost 2 years now. And he was on the phone with a bank teller going from representative to representative for almost 3 hours, and they got nothing done. So I wanted to know your thoughts on that, and if you believe that things like DeFi could inevitably teach the younger generation about money as a whole. Because the way I learned about how the way money works is through things like Bitcoin, but I do believe there is some value prospect to things like DeFi. Whether people want to acknowledge that or not, we'll let the market decide. Thank you, brother.
Well, I think you said it correctly. It's like let the market decide. Listen, it's something like 7 years ago. I was presenting somewhere, and one of the audience members randomly asked me, "What do you think about Bitcoin and decentralized finance and in general the entire space?" And I said, "Listen, it makes a ton of sense if you're an emerging economy and you don't have a banking system." It was basically at the time, 7 years ago, the real buzzword was micropayments, right? Kind of microfinancing, with cell phone to cell phone payments that are being done by people in other countries that don't have a place to actually deposit their hard-earned capital, right? So I am all for education. I'm all for people trying things. Again, I'm not all for people trying things without putting the time and effort in. Right? Maybe this is me being the old man yelling at the clown. It's not that I'm that old, but if you're going to learn something, learn it the right way. Learn it beyond just doing, but actually like study, right? So you said it yourself. you start understanding the role of money because of Bitcoin. Great, Bitcoin was a catalyst for you and a way of trying to get out of the system. God bless. I encourage everybody to think like that, but also to consider in their thinking how much they want to risk in whatever expression of getting out of the system is, right? So, long-winded answer, but yes, I think there is no doubt that this is an unstoppable direction. I have my doubts about the idea that DeFi upends traditional finance entirely, and that even if it does, it would happen in our lifetimes. The other part that's being missed by a lot of people, I think, when they talk in those terms, is time frame. And last I checked, I thought we were supposed to have flying cars by now, or autonomous driving. And that's not a slight on Musk or anything, but the reality is shit takes time. It takes a lot longer than people think. And that's why sizing, I always use that line, how much you own matters a lot more than what you own. Right? Sizing is the key to this.
Yeah, I agree with that. I think in the cryptocurrency landscape, I think we're sort of in the early 2000s, and I remember as a boy, like putting in that AOL CD. You had like 200 hours of the internet, and the UI was absolutely awful. And you were waiting about 10 minutes for Google to pop up, and that was post.com bubble, of course, and people were wondering, oh, this is all a fluke, this was all a scam. We're all gonna be still using fax machines and all that stuff. The beeper is still gonna be around. So I guess just not just to give some of the other people on the panel some more time with you, and not to ramble on and overtake the conversation. I want everybody here to have as much interaction with you as possible. I want to kick it over to Max. Max, if you want to chime in, maybe throw some things in Michael's way, in his current outlook, or some things that you want to ask him pertaining AI. Maybe we can leave that for Payne, but go on ahead, Max.
Yeah, certainly. Thanks, Wabi and Michael. Thanks again for being here. It's really great to have you up, and I'm looking forward to this discussion, being able to pick your brain a little bit. My question for you is, forgive me, it's going to be a little bit messy, but I hope you can understand where I'm coming from with it. So I went into this year personally thinking we were going to have a recession in the first half of this year. I was positioned for it. I was really heavy cash. I was one of the market participants that, for the first time in his life, in my short investing career, I'm about the same age as Wabi as well. We're both in our upper 20s. I was intrigued to generate a passive yield on some of my cash for the first time, really, in my adult life. That was an option because the interest rate environment that has more or less consumed my adult career so far has been, you've been forced to basically just like buy in at expensive multiples. And I felt like for a while we haven't necessarily had the same buying opportunities as the generation before us. We were entering into adulthood during a raging tech bull market, and we had these companies. I remember actually when I was in college, I watched Apple cross $1 trillion market cap for the first time, and I thought it was really cool. But I was like, wow, I'm mad I didn't get to like have some exposure to Apple 5 or 7 years ago, like some other people. I'm looking at what's happening in the market right now, and it's definitely surprising to me. I've been mostly cash all year. I've been kind of renting the rally, playing like short-term calls, like 2 to 4 week out calls, and some more complex option strategies just to capitalize on some of this upside. But what we saw in Nvidia is not exactly indicative to me, or screaming to me, we're about to have a recession. But then at the same time, we're seeing the 10-year minus the 3 month yield at the most extreme inversion we've, I think, ever seen. We're seeing the 10-year minus the 2 year extremely inverted, and potentially bottomed and beginning its process of uninverting. And again, today we saw a slight uptick in unemployment, I believe, from 3.4% to 3.7%. So there's certain sort of risk off signals that I'm seeing on the higher time frame, but I'm also seeing individual mega cap tech names, for lack of a better term, melt faces. I guess I just kind of like to leave it there and just ask what your outlook is for the remainder of the year, given some of the contradicting signals that we're seeing.
So when I was taking the CFA level 4 exam, there's a term in there that best describes everything, which is that the stock market is confusing as fuck right now. Okay, and you kind of just hit on some of those dynamics. Okay, let me provide context and set the record straight, because there's a lot of silliness that's happened on Twitter by either anonymous accounts or large accounts that, for whatever reason, are unable to read. I was very adamant saying there's a melt up coming October 3rd last year. And I said that because at the time, the speed with which bond yields were rising, had that speed of yield rise continue, it would have been the end of the financial system. You would have had mortgage rates by November at like 20%. If you were to extrapolate the speed that bonds were selling off and yields were rising. And you can't make money on the end of the world because nobody gets paid on it. So I put that tweet out. It was actually October 2nd. I said, the end of the world is at hand. That's why stocks are about to have melt up. And I was an adamant son of a bitch saying, we're in a melt up phase. That's it. We're in a melt up. December 2nd, I said there's a high risk of an imminent crash. Crash didn't happen. Fifth worst December in history. I'll take it, going back to the Great Depression. Okay, it's about conditions, not the outcome. Okay, conditions were there. Still a nasty, nasty December. There was no Santa Claus rally last year. Then after the first week of January, it went back to melt up. Stayed that way throughout. I said March would be volatile. Yeah, the regional bank crisis, markets were still positive for March. And then I started saying early April that I think the third week of April is when you might have the setup for a correction. Now, a lot of people fixate on that, and I kept on saying, jokingly, not jokingly, that I'm going to be annoying as fuck if I'm right about that October third week type of time frame. Now, you didn't have to your point, you did not have a correction since then in the large cap averages, but the truth is you did have a lot of divergences. Small caps failed to participate, commodities started breaking down. We saw what happened to the crypto space, right? Bitcoin, everything largely peaked around then, at least for now, short term. We'll see longer term. Now, all that is in the context of a pre-election year. Okay, pre-election years, the third year in the presidential cycle tends to be the strongest historically. Okay, and that's why I said I think we're in a melt-up year, but it's going to be volatile. You're going to have corrections within that, just like other years, right? So it can still be a positive year. Now, the thing is, as things have been progressing, the pre-election dynamic has not exactly played out according to script, because to your point, there has been no breadth, right? So Barron's had a headline piece from someone else that did research that showed that small caps, up until probably today, I think they're positive now for the year, small caps had never, at this point in a pre-election year, had negative returns. So there's something else that's happening. It's more than just the regional bank side. Lumber weakness suggests housing is going to be in trouble. Consumer discretionary stocks are weak. Retailer stocks are weak. So you've got this interesting dynamic where it's a tale of two very different markets. Now, the AI narrative, I think, is interesting because I think it's one of those here's the birdie type of things. No doubt, NVIDIA and the space has real demand. That's not at issue, right? So does Cisco, by the way, okay, at the peak in the NASDAQ bubble. The issue here is that there's a lot of narrative chasing around the next hot dot that people believe is going to overwhelm the world. Meanwhile, underlying dynamics still look pretty iffy. Now, on your point about the rest of the year, I've made this argument a couple of times. Not to say that you have to have something exactly like 1987, but you have precedent in that 1987 was a pre-election year. 1987, you had the S&P up 38% at the peak. 1987, you had a crash with the October massacre. And then 1987, you had a Fed pivot. So to think that you can't have all that happen this year, when it already happened in history, to me, I think is where people get very tripped up. Now, the big question here is, what is the rotation that's most likely? Are we going to see a rotation from large caps to small caps? So a widening of breadth. Today was a very good day on the small cap side, right? Or are you going to see a rotation out of equities into treasuries, which should be consistent with a correction, which again did not happen in large cap averages, but I keep going back to it wasn't a correction, it was divergence, right? I suspect it's going to be more into treasuries. Now the question is the path, how it plays out, right? And I say that because you're in a seasonally weak period anyway. May to October tends to be weak for equities in general. I think a lot of people are betting on small caps recovering in a sustained way. Maybe they will, maybe they won't. I'm not so convinced. And I think that a lot of this AI money movement is a function of people being afraid to position into bonds because they don't think it's safe anymore given the way last year played out. So what do? They go into the large cap names which are crowded, which to me, by the way, is an interesting contrarian signal on bonds. Like the fact that everyone's so bullish on tech as the safe haven play actually makes me very bullish on treasuries, right, from a path sequencing perspective. But I don't know either, folks. Like anybody that tells you on FinTwit they know exactly what's going to happen, please fucking block them. You have to think of things in terms of conditions and sequences and path. Everyone talks in terms of endpoint. The endpoint doesn't matter. It's about how you get to the endpoint. I am no better than anybody else. The only difference between me and everybody else is that I actually can prove somewhat from a testing perspective that certain areas have predictive power, like utilities, like treasuries, like lumber to gold, like moving averages, like the VIX at extremes. Everything else is largely noise. So goes back to the self-education process. Get involved in markets, but also be able to recognize bullshit from what's real. And at least I have skin in the game. I haven't done very well, obviously, with the strategies I launched because the cycle has been purely about large caps. But beyond this period, I can prove with actual data that this stuff has predictive power. So long-winded answer, but bottom line is, you're right. It's a confusing market. A lot of people, I think, are being deceived in thinking that it is a traditional bull market. It is not. You've never had as much idiosyncratic risk in the S&P 500 like you do now. I put out that tweet. It's like 25% of the S&P is five stocks, driven by five stocks. The weighting is five stocks. Like that's never happened before. This is a diversified portfolio having company-specific risk is pretty wild when you actually think about it, and pretty dangerous.
Michael,
Hey, what's up,
all right,
Michael?
go ahead, Payne. Go ahead, brother.
Oh no, I just wanted to have a question about your last statement. So, what would it take for you to say, okay, we are in a bull market, or this is a bull market?
I find it interesting to think about the definition of bull and bear. Okay, so I get it. We trade nominal prices. So people say, well, the S&P is flat for the last year and a half, and Nasdaq's pushing. Okay, after inflation on a real basis, that's not true, right? Because inflation is eroding the nominal price. Here's the truth about definitions. You don't know if it's a bull or bear market until the prior drawdown is overtaken, meaning you have to make new highs, and you have to totally crawl out of the drawdown that happened last year, which was the October low in the S&P. So it's like when people say, oh, you're up 20%, so that's a bull market, or you're down 20%, that's a bear market. That's not true. It's where was the higher watermark? Like until you're out of that higher watermark, until you've actually blown past it, you cannot say with confidence that it's bullish or bearish. You don't know, except for the hindsight. Now, for me, and this is so fun, I have to say, it's utterly amazing to me, because in January I was saying, after that first week, I said melt up, and I said I still think we're in a bear market in the context of that melt up, and nobody was countering me when I said that because everyone was still bearish. Now they're all countering me. They're all saying melt up and it's a new bull market. Okay, the reason, and maybe this is me hoping, okay, because I have a bias like everybody else. My bias is I want to see volatility, not a bull market or bear market. I want to see both, right? I want to see the sequence because that's what I need for ATAX, Roro, and JoJo. I'm going to pull it up and share it at the nest. The reason I keep saying I think we're still in a bear market, okay, aside from the fact that we haven't taken the new highs to the prior highs yet, is okay, small caps not participating. Retail is still at pretty much the October low. But I'll share at the nest the chart that I've put out many, many times, which thankfully got like 6 million views, which really explains the hell I went through last year. Okay, so hopefully that shows up in a second. Let me just share that here. I'm going to retweet it as well. Okay, so this chart, if everybody can see it on the top of the Twitter space, this is the most important chart to help people understand the environment that we've been in and where we might still be in. Top 20 biggest drawdowns for the S&P 500. Going back to 1961, biggest peak to trough declines in history. Okay? That's in gray in that chart, in that tweet. The purple is long duration treasuries, TLT, as your proxy. It's not my imagination. Okay? 10 out of the 20 biggest declines for the S&P, treasuries made you money. As the stock market is going down, treasuries countered as the safe haven risk off play. 9 out of 20 times treasuries lost, but they lost a lot less, like the 70s. The narrative that this is like the 70s is just not true from a sequencing perspective. The far right was what happened last year, which is what I called hell, where long duration treasuries went down more, had a bigger drawdown than equities in the top 20 drawdown for equities. People looking at that on Twitter, they say you should have seen that coming. That's because the Fed hiked rates. Bullshit. The Fed hiked rates 2 years after the drawdown in long duration treasuries began. The Fed does not own the bond market. The bond market owns the Fed. They say that everybody could have seen that stocks and bonds would lose money. Sure, that's the end point. 74% of the year last year, treasuries lost money using weekly data. 59% of the year, the S&P lost money on a weekly data basis, most since 1931. Wasn't that they both lost, it's the way they lost. It's the sequence, the path, which is all that matters. The assumption on the far right, which goes to your question about why am I still saying bear market, the assumption on the far right that treasuries fail to act as the safe haven is that the drawdown for stocks is over, meaning that we're locked in on those lows from last year. What if we're not? So if you break the lows from last year, means we're still in a bear market. The gray, which is the S&P on the far right, goes down further because you broke the lows from October. And maybe in that case, the purple, which is treasuries, counter this time around. That flight to safety dynamic, which you saw briefly during the regional bank crisis, asserts. So if you look at that chart, I know everyone says this is like the 40s or like the 70s. I think this is going to play out in the fullness more like 1968 to 1970. Third from the left in that chart, you had treasuries down 14% during that equity drawdown and the S&P down 32. So they both sucked, right? But treasuries still sucked a lot less. My whole contention around whether it's a bull market or bear market is I believe that the relationship of stocks to treasuries has to be righted, which, by the way, would happen if you have a recession, right? It's like what happens in recessions? Yields drop. What happens in a recession? Stocks drop. Everything I've been saying has been consistent, all relative to the way last year played out. And final thing I'll say, and I know I'm kind of talking a lot here. People keep forgetting that interest rates act with a lag, which is insane to me. The regional bank dynamic happened not because the Fed was hiking rates this year, it's because they were hiking rates last year. It happens with a delay. So nobody in this Twitter space can possibly tell me that there isn't a potential tail event out there, because we have yet to price in interest rate hikes from months ago. We probably already over tightened. Nobody wants to think of those terms, but you don't know except with hindsight. So my role and the way I see myself on Twitter and in this kind of FinTwit community, whatever you want to call it, is I try to be loud and aggressive purposely because it's a persona, right? On Twitter, I make that very clear. Anybody talks to me one-on-one, doing business, all this stuff, that's my professional self. This is what gets engagement. But the reality is, I hope to get people to think differently, because if you're thinking like the crowd, you're not thinking.
Definitely agreed here. Guys, we're just about to cross the halfway mark for this Twitter space. So if you guys are enjoying the space, my name is Wabi. I'm acting on behalf of Because Bitcoin Twitter account, and we're hosting Mr. Michael Gayed. We're talking about all things financial markets, whether it's risk like crypto and growth names, and also some macroeconomic stuff, bonds, rates, all that good stuff. And if you guys are enjoying the conversation, feel free to give us a follow. We do shows like these all the time. And if you guys want to connect more with us, we do have some of our links in our Twitter bio. And I also see Dr. Jeff and Matt, good friends of the brand. If you guys want to come on up, feel free. Sent you an invite to speak. As always, a pleasure to have you guys on. And it's awesome hearing Michael speak and, hearing his outlook. And speaking about outlooks, Michael, I want to introduce to you somebody who's a jack of all trades, or rather, a jack of all outlooks, man. This guy, Michael, let me tell you, this guy can cook. This guy can drive like Gran Turismo, an F1 Formula race car driver. This guy is built. He is the outlook. So, Will's outlook. Introduce yourself to Michael, and I'm excited to hear your outlook, brother. What's going on, Will?
Hey, Michael, how's it going? Yeah, I think you have a lot of great takes, hence why I follow you. I think there's a lot of people in the space with a lot of great takes and good points at the same time. And I like how you move towards kind of the theory of, that banks lagged on the interest rate hike, or interest rate hikes. And I agree with that. I think a lot of things lagged. And I had this discussion with some people before, and they were like, oh, the Fed hasn't done enough. I'm like, I'm in the camp that they probably over tightened too, right? Like it doesn't hit all at once. It takes its time. I think it creeps into the economy and works its way out. I've been kind of more in the boat though, looking at the 10-2 and the inversion and looking for the uninversion, because that's typically after you get the uninversion after a long period of time being inverted, you you tend to have that recessionary period, and you tend to form some pretty nasty drops. So I'm kind of looking for that as a headwind, but I'm in the same boat as you. It's like it's up only until then, right? Like until these scenarios kind of fill themselves out and the economy recognizes what's actually going on, which will be too late for a lot of people. They'll end up kind of riding this thing all the way back down, potentially even lower lows at some point, at least in some sectors, if not all. And again, because I've been around for a long time. I'm a millennial, so I've seen the tech boom originally from '00 to 2010, and I had this discussion today with Max and some of the other BB guys, and I was just like, I'm like, this could very well be, a scenario, and I know you named different dates, but, like 2000 to 2004, 2005, where we just get back to all-time high on SPY and everything else. And then from there, we go right back down to the lows again and actually form lower lows, just like we did in '08,
Which
'09.
by the way, sorry, and well, not to interrupt, but I had brought up this scenario before as part of. I said I would not be surprised if the market hits new nominal highs, nominal, but after inflation, you're still in a bear market. That's what I'm saying. People are they're not understanding the real versus nominal discussion.
Michael, when you say nominal and inflation and all that stuff, are you talking about this one chart where it shows with inflation adjusted, the Nasdaq actually didn't even break all-time
Yeah, of
highs. It
course.
actually just did a double
Yeah,
top. It did a double top
Correct.
with the
exactly right.
2000 high,
Yep.
and that to me, just shows the animosity and absolute terror up thrust from the dot-com bubble. People think that, like, with some of these altcoins, which I do trade altcoins, full disclosure here, people think that this is something that's never happened before. But man, some of these names from the dot-com bubble, like Amazon, I think Amazon did something like a 200x in like 3 years, dude. Back
No,
in the
Amazon during the dot-com crash, and at the time of the dot-com crash, Amazon, I believe, was not even in the S&P 500. It bottomed 1 year before the S&P 500 did. During that time, the S&P 500 drew down about 30%. Amazon, as an individual name, had about a 200% move to the upside.
Yeah, and kind of to that discussion, that's the thing. This kind of melt up period, right? It's not going to be in these big indexes. It's going to actually be in individual names, and you just got to pick the right names, which I think we've already seen that with Nvidia, which still has potential, right? There are individual names I think that will prevail in this, but ultimately they'll end up rocking right back down to the lows again with everything else. But there's good. This is the melt up scenario, right? I think people looking at things like SPY and DGI and Russell and stuff like that, and thinking that they're going to breach all-time high, I think they're approaching this with the wrong approach. They need to be approaching it with individual names if you're looking for the melt up, and then you're looking to get off that melt up once it occurs and kind of wait for that melt back down.
Right, but in
Scenario to
fairness, that's
potentially
also
occur.
really hard, right? I mean, it's like I get it, but it's like in practice, like somebody sent me a tweet saying, why don't you just play it with a trailing stop? It's like, well, if it was that easy, everybody would be rich. Like it does, it's right.
100%.
But the other part of
100%.
this, and this is why I also have a problem with the argument that you have sort of a sustained rotation out of the large into small. It's like narrative always follows price. So people forgot that the real narrative that matters is you have a lot of zombie companies, okay, which probably are not going to be able to roll over their debt and survive on higher rates, which are a lot of small cap companies, which are a lot of retailers. So you're right, by the way, on if you're going to do it, you should probably be very, very selective, because you could have the Russell 2000, for example, have a ripper of a move like today. The question is, how sustainable is it when you have fundamentals, which at the end of the day, stock and company are different, but they will merge at some point, right, in terms of valuation. The question is, can those smaller cap companies on these higher rates roll over that leverage, and survive? And that's why I think this is that. It's funny because that was the correct narrative at the start of the year and at the end of last year, but somehow everybody forgot that now because they're just looking at the large to small ratio, which is back to the COVID crash levels, as I keep noting, maybe for good reason.
Yeah, and we had another discussion on that too when it came to small caps, mid caps, and basically what I had discussed with them is, hey, we'll probably see small cats and mid cats bid temporarily as just kind of like a liquidity
Right. It's a
grab, right?
trade. Right.
And that and then once that occurs, those small cap, mid caps are going to roll right back to where they started. If not, possibly go bankrupt. Like we already saw BBBY come off the 8 cent mark all the way up to 30, right? We saw AMC and GMC. I mean, these are zombie companies essentially. They literally have no value. They're basically penny stocks, and we continue to see these things bid, even though they have no place and no value. So like those are more of the high risk end of the curve that I think they typically bait retail into, and then once they bait them in, they just take that liquidity right back to whatever they're already in, whether it be Nvidia or whatever, to continue the push. So yeah, I agree. I just when I speak on rotational capital, I'm typically looking for them to rotate in and rotate right back out.
Which goes back to you can be bullish and bearish at the same time, which I keep stressing, and this is what JC Perret said it correctly. It's like 99% of these FinTwit silly battles that people have can be resolved if people just outline their time frames on things. Right? It's like you can be bullish short term and bearish long term. You can be bearish short term and bullish long term. It's about the path.
All right, so we're gonna go on over to Tucker, and then we're gonna go on over to Matt, and then Dr. Jeff. Tucker, what's going on, man? Feel free to introduce yourself to Michael, brother.
What's up? Thanks, Wabi. Great to be speaking with you right now, Michael. Yeah, I just wanted to touch on a couple things. I don't know if you guys, sorry to pop in late. I don't know if you guys have talked through the TGA refill yet or not, but I just wanted to get your take because my understanding is that if they refill the TGA via bills, right, short-term bills, it shouldn't have as much of an impact on market liquidity and obviously debt market liquidity in that process, right? But if they were to refill it via duration, right, the long end by issuing bonds versus bills, then it would have more of an impact on both equities and obviously the long end. But I don't know if you had any insights there because it's kind of been a hot topic on FinTwit lately. But I've been trying to figure out exactly how they're going to do that and what that's going to look like kind of in the next few weeks. So yeah, whatever you think
Yeah.
there.
So okay, just on the point about thinking about mechanics, it's never just one thing that drives movement. Okay, so I poke fun at squiggly lines, right? Because I think a lot of people show these technical analysis patterns and charts and lines, and they look really great, but nobody ever backtests them to see if there's any predictive power, right? True technicians don't care what they're looking at; they look only at price, right? It doesn't matter if it's oil, bonds, Dogecoin, whatever. Intermarket analysis, which is the school of thought that I focus on, says that what you're looking at matters. I'm going to answer your question in the context of this. What's sort of a classic intermarket relationship? It's the relationship of oil prices to bond yields. So when oil prices rise, typically bond yields rise. Bonds sell off, yield rises, right? And the reason is very clear. Oil is a form of cost push inflation. So as oil prices, so as oil prices rise, inflation rises. As inflation rises, bondholders start saying, treasury holders start saying, I need more yield. I got to get compensated for that erosion of purchasing power. Now, the key thing is that it doesn't happen right away, meaning oil will move, then inflation expectations move, then bond yields move. So when did oil peak? Peak June of last year. When did the 10-year treasury yield peak? Right, October of last year. So, and that's not a coincidence, right? So I'm trying to get to your question about the refill and how it affects bonds. The duration question will be a function of what else is happening around bonds at the time that they're doing that. So oil prices clearly are showing weakness, which is disinflationary, which should push yield prices lower. So that could counter any kind of new issuance of supply. That's why it's not as clear to me as to say, well, like I saw those stories, you're going to have this huge flow of T-bills that enter the marketplace. Okay, but if oil goes down to 40 or 30 a barrel, that's going to get soaked up pretty quickly. Right, so it's nuanced is my point. I don't have a full opinion on the mechanics of it, other than to say that there's a lot more to the story than just the mechanics of what the Treasury does. Does that make sense?
Yeah, no, that's perfect. Yeah, I've just been doing a little research trying to figure out. I think they were saying like 25% of the refill will be from bills rather than bonds. And the argument was that it'll not only have less impact on obviously the long end, but the debt market in general, but also equities, right? Because that's kind of the thesis right now is obviously the TGA refill will drain liquidity from the equity market, you know, as a sequence of events, obviously not directly, but yeah. So just it just depends how they refill the TGA, not just the fact that they're doing it, right?
Right, and again, sort of I'd argue what commodities are doing at the same time, and how that impacts the cost push side. The demand pull inflation side is intriguing because I keep going back to retailers, consumer stocks, all of those areas look pretty weak. So if the stock market in terms of consumer sensitive plays is massively discounting anything that is based on consumer spending, if you don't have commodity cost push, you don't have demand pull. Suddenly inflation breaks down pretty quickly, and if that happens, then they may not be able to issue enough bonds.
Payne, go ahead, brother. After Payne, we're gonna go on over to Matt and then Dr. Jeff.
For sure, what's going on? I just had a quick question for Michael. I'm curious as to how much of an emphasis or how much of a factor just overall market sentiment is within your positioning, whether it be a personal portfolio or ones you're managing. For me personally, it's probably the biggest signal I've used, and in my personal experience, like I started getting really bullish on tech publicly last November or so, when you had things like Jim Cramer crying on TV and stuff like that, where everyone was basically just betting on the imminent end of the world. And then going into the year, I think we had like 85% of people positioned net short. And so my thought process was like, okay, well, even if we get this recession, it might come later than what everyone's saying. And if that's the case, then it's basically by a default a melt up. And, my whole point is that I wasn't looking at charts necessarily or like staring at patterns or formations. Almost all of my underlying thesis was just, based off what everyone else was saying. And so I'm curious as to just in general how much you pay attention to that, or if everything that you look at is primarily technical. Yeah, just curious to hear your thoughts.
By the way, on sentiment I shared in the space, the first time I actually said melt up before I said every W needs a V, which was mid-August, was the day that CNBC flashed on TV, markets in turmoil. So speaking about sentiment, right? It's like I use that line many times. Opportunity always exists when the crowd thinks it knows an unknowable future. So the moment that everyone gets hyped up one way or the other is typically a sentiment tell, and the media is very good at playing that off because that's how they get ratings, right? And that's their incentive. But as far as what I do as a portfolio manager of these three funds, ATAX, Roro, and JoJo, they're rules based again. So it's not as much as I talk about sentiment on Twitter as a tell from the perspective of the lead lag report and the research I put out. It has nothing to do with my funds. Right? I believe that the behavior of utilities against the market is the ultimate way of telling you sentiment. I believe that lumbered gold is the ultimate way to tell you about sentiment. Same thing with treasuries. So rules based, mechanical. As far as my own personal investments are in my funds. This is something which, again, I kind of ranted on this a little bit. People would rather follow large anonymous accounts that sound smart when you don't know if they have skin in the game. Folks, to be an entrepreneur in the fund business is one of the hardest, most brutal, and most rewarding, if you get it right, types of paths to take. It takes, it's at least 250,000 or so to bring a fund to market. So that's like an albatross on my neck, right? That's rent to pay every single month to keep these funds open that I believe in because I know the strategies, I know the cycle comes my way, right? So, people can like or dislike what I have to say, or like or dislike the performance of the strategies, which I built, which I believe in. But the reality is, I've skin in the game. A lot of people tend to not, and it's those people that tend to not have skin in the game that tend to be also the loudest about the market's trend. Now, I've seen this too many times to count. I can't prove it quantitatively, but it really is true. When you get people vitriolically attacking and insulting and poking fun at a particular view when the market is going against that view, that tends to be a turning point. That's more than just Twitter. I used to be one of MarketWatch.com's top writers. For 3 years, from late 2012 to 2016, I was one of their top writers. I could tell whenever I would do a writing that I would be right based on the comments section of those articles I wrote, where people would outright insult me. They weren't providing counter analysis; they were outright insulting me personally, right? And I've used that line many times before. You know you're right when the counter argument is an insult. We're there now again. It keeps happening. It happened during the October low. It happened in December. It happened when I said melt up again after the first week of January. It happened in March when I said I don't think this is the credit event during the regional bank run up. It's even happening somewhat now. People are like, oh, what happened to your third week of April call? It's not a call, it's conditions. And to deny the fact that breadth and everything started diverging in starting the third week of April is silly, as people don't provide their own counter analysis. Today was really interesting to me. Again, as somebody who's been risk on, right? Today is really interesting because I could there's a certain degree of real ugliness that comes out of people at major turning points. I see it now from the bull side, just like I saw it from the bear side in October. I can't prove it. Maybe it's wrong this time. Maybe the bulls are going to be fully right. It's going to keep melting up. But when you see overconfidence by the crowd, you have to be really careful. Has nothing to do with my funds, right? But this is more just me putting a spotlight on what I have observed time and time again, that the crowd is right on average, but wrong at the extreme, and the crowd is always loudest at the extremes.
Some great discussion here, gentlemen. We'll kick it on over to Matt. What's going on, Matt? Great to have you here, brother. And just want to point it out that Matt, earlier this year, I believe the week after New Year's, his whole thesis was letting the data dictate. And, you know, if unemployment comes in good, if inflation numbers come in good, we'll just keep on ripping. So, Matt, I want to welcome you up on the stage, bro. If you have anything to throw at Michael, you know, would love to hear it. Always great having you on these discussion panels. And after Matt, we'll kick it over to Dr. Jeff, and then we'll kick it on over to Michael J. Kramer. I've tuned into some of his spaces before, and, you know, they're quite lively. So it'll be great to hear from him during this panel. So go ahead, Matt.
Hey, thanks, Wabi. Well, I can't believe it's been a year. Michael, good to talk to you again. I remember those spaces like it was yesterday in summer 2022. And on that note, I like to look back, you know, the last 12 months, see what I got right, see what I got wrong, see where I can improve. I'm sure you've been thinking similarly. In hindsight, what are some of the things that, oh yeah, that seemed to play out, that might have been spot on, and maybe one or two things that, like, yep, that was surprising even to me and didn't play out like I thought it would.
So I think with hindsight, it was spot on that stocks and bonds would fall together. What was surprising was how they fell together. Again, I go back to the path, which is what so dramatically impacted my own funds. And I keep going back to, it's not about the end point, but the dance in between. That was the surprise for last year. You know, I put a tweet out, and I still smile when I think about it, because I'm actually a big fan of Nassim Taleb's. And I put a tweet out in June. And by the way, for those that are in the audience, I don't mind being wrong and being told I'm wrong, as long as I'm legitimately wrong, and as long as my process is still right. That's the key thing. You just said it correctly. It's like, you know, you look back on the outcome, right? What'd you get right or what's wrong? The single roll of the die is not how you determine if something's right or wrong, right? It's the process. It's the multiple roll of the die. It's the probabilities, not the small sample that we all live in. Okay, so in June or July, I think it was June, I said, you know, the black swan wasn't that stocks fell, wasn't that bonds fell, it was that they both fell together. And Taleb retweeted with a comment saying no, and all kinds of people started attacking me, saying, oh, imagine this guy thinking stocks and bonds going down, couldn't happen. And admittedly, I probably didn't word the tweet correctly, but I keep going back to that point that it wasn't that stocks and bonds went down that was the surprise. It was that the flight to safety trade failed because of the weekly interaction of stocks to treasuries. You could have had stocks go down in the second half of the year and bonds go down in the first half of the year, in which case it would have been fine for my own funds. It's that they went down in this very correlated week after week after week way, which had never happened before in history, which is an outlier, right? And that's not debatable. People say, oh, it was an outlier. I have the data, they don't. So that's one thing. I think the other thing is that's been a surprise is what's happening right now this year. Again, because I was very loud and bullish saying melt up, start of the year, And the fact that you had this tremendous divergence in small caps and large caps is surprising compared to history in pre-election years. Maybe it resolves itself, right? But that's markets are funny, right? You can be both right and wrong at the same time based on your opportunity set, and markets are the only domain where you can be wrong and lose and make money, or right and lose money, right? Depending upon the timing of things. So I think those have been, for me, the most surprising. Now, having said that, all that's with hindsight. It's always easy to cherry pick and argue that something was seen or not seen when you have the full visibility of the past. But I do think that what's missed by a lot of people on FinTwit is the historical data on the past behavior, as opposed to, is it a bull market or bear market? Does that make sense?
Yeah, that's great. Thank you. Appreciate it.
Great hearing from you, Matt. All right, next up we got Dr. Jeff. Great having you up, brother. How you doing?
Hey, I'm doing well. Thanks for having me up, and it's been fun hearing Michael. Michael, I only caught I probably caught the last 10 or 15 minutes of what you were talking about, so I missed kind of the first part of your thesis. But I think from what I'm gathering is you're fair, and don't let me misquote you, but you're fairly bearish. You think this run in the Nasdaq stocks is probably not going to go on for much longer, and that's what that was going to be. And correct me if I'm wrong, but I wanted to ask you that, and you touched on this a little bit just a minute or so ago, between the huge divergence between small cap stocks in the U.S. and the Nasdaq stocks year to date. Looking at my chart, the Qs are up 34%, while even after today's huge rally, small cap stocks are up about 5%. So what do you think is going to go on with that divergence? That's question number one. Do you think small cap stocks catch up to the upside, or do NASDAQ stocks catch up to the downside? And then second, what do you think about bonds here? Do you think long dated bonds, TLT, those kind of treasuries, do you think they're a good buy right here? Or do you think they continue to chop sideways?
So the first half of this Twitter space was me basically just saying on and on and on, where the fuck is Matt Damon, and Nvidia's fucked. I'm giving you the recap of everything that I said the first half. But by the way, that is directly related to your question, which I touched on a little bit, but let's expand on this. Russell 2000 being up 5% year to date. That's almost all because of today. Okay, a big chunk of that was just probably today's performance, but also on a real return basis, that's still flat, right? I mean, after inflation is probably negative on a real return basis. And I keep going back to the script of the pre-election year on small caps is not playing out according to history. So something is different this time around. This is not open to debate because that's facts. That's in history. Now, I go back to, can small caps play catch up to large caps? Sure. No doubt. I don't think it happens because seasonality is against it, at least now. I could be wrong. And I put a piece on Seeking Alpha basically saying that what's happened the last few weeks has been interesting. You had essentially capitulation in defensive sectors the last 3 weeks. Meaning, if you look at the relative strength of utilities, staples, healthcare, the three low beta parts of the stock market that tend to be the real places to hide, massive underperformance in a really, really sharp way. Almost like capitulation, like you'd see on a price chart, which would say you're probably at a low as people just dump out of defensiveness because they've given up on the bear argument, right? Which is probably why it starts to reassert. So the fact that you've had what looks like capitulation the last several weeks in defensive sectors would suggest that on a rolling basis, they may have bottomed, and then you're going to back to kind of a risk-off sentiment play in the next few weeks, which is why I'm estimating, I think mid-June, you could kind of go back to a high-risk period. Got May to October, sell may go away type of period, not necessarily negative for stocks, but not necessarily positive. Makes it, I think, hard for small caps to run. You still have a hell of a lot of weakness in lumber, and people seemingly forgot that Home Depot earnings, suggested that lumber was falling off a cliff, because guess what? Home construction is probably about to fall off a cliff. I get it. People say, look at home builder stocks. Home builder stocks are not predictive. Lumber is. I can prove that. I have a whole paper on that. and on the point about treasuries, again, selfishly, I want to see that flight to safety dynamic. When I talk about treasuries, the whole Phoenix Rising idea, I'm not talking about owning treasuries to maturity, right? What I'm talking about is a very well documented phenomenon that when you have these high volatility sequences, meaning, big ups, big downs in equities, there's a flight to safety trade. Money for a moment in time goes into, in quotes, safer, less volatile assets, which would be AAA bonds, utilities, staples, healthcare, because they're, need sectors, not want, and then ultimately duration treasuries. I think treasuries are really interesting here. because nobody seems to be of the mindset that they can ever outperform equities again, at least even for a few weeks, even for a month and a half, which is what would happen probably in a correction. So I lean more towards the possibility that the rotation is not from large to small, but from equities to treasuries. Having said that, it has nothing to do with the way my funds are positioned, right? Because they're going to do what they're doing based on the signals, which I try to give voice to. But it's my suspicion that the real contrarian trade isn't small caps, it's really treasuries. For now, it could be small caps after that, which is why I go back to sequence, path. You can have both. The question is, what's the timing?
All right, excellent. And next up, we have Michael J. Kramer. Michael, I want to welcome you up to our show. We've never interacted before. I've just been more of a lurker on your spaces whenever you've hosted them, brother. Want to welcome you up. Thanks for coming on the panel, man. What's going on, brother?
Thanks for having me. I'm a big fan of Michael's work and been following him for a long time, and we've done a couple of spaces together as well. And I wanted to ask Mike what I find really interesting in this market is the equity risk premium of stocks to bonds and how it's just collapsed over the last few weeks. As like Michael, I'm sort of an intermarket analyst as well, and the one thing that's worked really well for the last 5 years is looking at the ratio of the Qs to the tips. And that ratio is just completely broken down and doesn't seem to be working at this point in time. So I wanted to see if he had a take on what's happening there.
It's we're in a mania. I think it's a selective mania, but we are in a mania, right? And the thing with this stuff is that there's always mean reversion in markets, right? It's like I've used that analogy before that in this business you can never guarantee anything, right? That's a hell no from a compliance perspective. The only thing that you can is as close to a guarantee as possible in markets is mean reversion, right? Now we can debate where the mean is because the mean's always changing, but mean reversion is the one constant in markets and in life. And I always go back to mean reversion is a concept that's as old as the Bible, right? He who is first shall be last, and last first is mean reversion. So I haven't looked recently at the Qs against tips and the other equity risk premium, but I can obviously imagine it. That sounds like the setup for a mean reversion, which would be risk off, which I keep going back to. I think it's going to be more rotation out of equities into treasuries for a moment in time than from large to small. But I could be totally wrong. And by the way, folks, it's okay. Stop going after people that are in quotes wrong in a moment in time. Provide analysis. Provide something that's thoughtful. You don't grow by attacking. You grow by collaborating.
Exactly, man. Exactly. Michael, I know you DM'd me that you had to go after Mr. Kramer spoke. So
Keep Kramer on. Kramer should be the special guest. He's the man. I'm sincere with it. No bullshit. Mike is a good guy. He's one of the good ones. Very, very articulate. Very, very smart. Everyone should follow him, not me. Okay, and let him be the guest for the hour. I'm just another guy trying to make it in this world.
Well, we can we can keep the conversation going. I know you had to go. Max, I'm not sure if you want to keep the spaces rolling. Same thing with Payne and Will. If you guys want to keep the conversation rolling, I'll keep having the spaces up. But I do see we have a little over 400 people. Guys, if you're new to the spaces here, my name's Wabi. I'm the individual behind the Because Bitcoin account when we do our Twitter spaces and network outreaching and all that stuff. So if you guys can give us a follow, would really mean the world to us. We're going to be putting out a lot more content across all social channels here on Twitter and also on YouTube. And this space is recorded here on Twitter and will be uploaded onto our YouTube channel. Want to give a shout out to Mr. Michael Gayed for taking the time out of his lovely Friday to come talk some shop with us. It was an absolutely marvelous time. Hopefully, we can continue the conversation on a YouTube collaboration sometime in the next month or two. There's a lot of stuff that I personally wanted to touch upon. I do, excuse me, I'm going to have to go inside. I just got home from the supermarket. I'm going to go ahead and drink some water from Iceland. At least that's what the bottle says. I'm not sure if you guys I've had that water before. But yeah, Michael, before you go, where can people keep up with you? And also, if you can answer this one last question, brother, what do you touch upon in your own personal life? When you're feeling down and out from the market, some people have a bad day, bad week, bad month. Some people even had bad years. What's your advice to those people that, aren't really feeling too good about the markets and, they've had a few bad trades and, are looking to sort of uplift themselves? I think getting caught up in these markets, we tend to forget that, we're human. We end up sort of being robots if you really think about it. I know some people think that AI hasn't even fully immersed in our lives yet, but when we stare at charts, when we look at all these analytics, we're essentially getting money. I mean, we're essentially getting not money. We're essentially getting knowledge from the great machines. So would love to know sort of like a concise answer about that before you go, brother. Sort of a heart-touching point, if you will.
Yeah, I appreciate it. And obviously, besides Twitter, I've got the podcasts, which are from the Lead Lag Live spaces that I do on YouTube, Spotify. You ask a good question, and I always go back to there are no gurus, only cycles, and that just doesn't apply to markets, but that just applies to life. There's a chapter in my father's book where he quotes Ecclesiastes. Okay, time for everything, right? Time for everything. Season for every activity under the heavens. A time to be born, a time to die. A time to plant, a time to uproot. Time to kill, a time to heal. A time to weep, and a time to laugh. I'm not going to say the whole thing, but my point is that there are cycles. There are higher lows and lower lows in life, but nobody can predict the future, which means you don't know where your own cycle is going to be in terms of advancement or non-advancement. Just keep positive. It's not an easy life, and I think I tend to be more of the mindset that life is misery, with occasional periods of joy and happiness. But you've got to just kind of keep pushing forward, because if you believe, as I do, that nobody can predict the future, that means you don't know if tomorrow's going to be better or worse. So take it as it comes.
Beautiful, man. Thank you for your time. Max, if you want to give the closing thoughts, brother, go on ahead, man. And then I'll go ahead and wrap up the space.
Yeah. I don't have too many closing thoughts. I want to thank everybody up here on the speaker panel, specifically Michael. Well, I guess both Michaels, and then Matt and Dr. Jeff, of course, the entire Because Bitcoin team. I want to wish everybody a really solid weekend as well. And if you enjoyed the space, consider giving us a follow here at Because Bitcoin. We're pressing up against 10K. We're getting really close. We've been working really hard to get there. I was hoping we'd hit it by the end of this week, but we'll see if we get there or not. But yeah, no closing thoughts. Is really great discussion, really great week, and thanks everybody for tuning in.
All right, guys, take care. God bless you, and we'll see you all on Monday. And as Max said, feel free to turn on bell notifications to keep up with all of our content, all of our shows. And if you guys are interested in communicating more personally with our team, we do have a few links in the bio. We have our newsletter that's rolling out next week. And also we have a deal going on with our Discord. It's more of an emphasis on trading and crypto and all that good stuff. That promotion is still going on for a few more days. And yeah, feel free to check that out. And as I said before, this segment of our Twitter Spaces will be uploaded onto our YouTube channel, and it's the same name as our Twitter, Because Bitcoin. So I guess we can just close it off here, man. Will's Outlook. Is there anything that you wanted to say, brother? There it is, a thumbs down. Tucker, any closing thoughts, bro? Oh, dude. Oh, come on, man. Matt, any closing thoughts, man? Let the data dictate. Oh, brother, damn.
Just stone cold thumbs down, Wabi. it's so aggressive. It's like it's not meant to be that way, but it just comes off.
Yeah. Will's Outlook starts. He starts a trend, man. So, all right, guys, that's it for me. I'm gonna stop. Stalling now. So.
Oh, and real quick, Michael Kramer. I'm hoping we can send you a DM after and get you up on a space. We'd love to pick your brain. I followed you for quite some time as well, and I think it'd be a really fun one. So please look out for that. We're definitely going to reach out to you, and thanks for coming up.
Beautiful. I'll go ahead and send that message right after the space concludes. So thank you guys so much. Take care. God bless you. And we'll see you all on Monday. Take care.
Take care. Thanks, guys.
Sí, 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 sí.